Good morning, good afternoon, good evening, no matter where you are in the world. This is Howie, and I'm here to help you win with money. Today is Tuesday, December 28, 2021. I want to briefly talk about the markets. S&P 500 hit new all-time highs yesterday, and it's still green today. I have no idea what's going to happen. You see Nasdaq is showing some weakness. Maybe Santa Claus rally is going to take a few days off and then resume towards New Year's or New Year's Eve, and then run into the first 2 or 3 days of the new year. So let's see what happens. Couple things I want to talk about. I have to apologize for the last video. That one was horrible. It was recording using the wrong microphone. It was like the default PC microphone, and I sound so far and distant. But I want to talk about Tesla trades. I've been doing Tesla trades for the last few days or last 2 weeks, and you'll see I think I'm in good shape for the one that I wrote that's expiring. I have some Tesla trades that are expiring on the last day of the year, so I made money there. I don't think it's going to drop another 100 and something points between now and then. I may take my profit early if you already hit your 60, 70, 80% profit of the trade. Sometimes I just take the money and walk and open a new trade. But this video, I want to do something a little bit different. I talk a little bit about what I do. I do stocks, I do options trading, I do credit card hacks, I do anything that adds another dollar into my pocket. But today I want to talk about a little bit of why I'm shifting more of my future paycheck into a different asset class. And a lot of it has to do with risk. Where can you make the most money? If you're on Facebook, join Facebook group Investing 102. This is where you'll see I post a lot of my trades nearly in real time. You see that I have some trades over here. You'll see it. I posted this, my Tesla trades. I post a lot of my trades. You'll see it in real time. You don't have to wait for a YouTube video to see it. Again, I'm fully transparent. I list what I trade. People see what I trade. I'm not just going to post my winners and then 5 years later you see how I did it. Nope, you see what happened when I did the move. Again, full transparency. When I lose money, you'll see it. When I make money, you'll see it. So that's the best thing about joining that group. So let's get back to today's topic. How do you measure risk? So I'm not going to spend a lot of time on it, but there's two things you want to look at. There's this symmetrical risk. Is when things are risk and reward payoff are equal. Think of a game like if we're going to flip a coin and it's head and tail, and me and you will put money on it. If you put money and bet heads or tails and play it over a long time, at the end of the day, we'll probably break even. Very few dollars will be transferred between the two players. And that's how symmetrical risks work. Asymmetrical means the opposite, right? It's there's two ways. It could be a positive or negative, but you can either put a lot of money and make very little, or you can put very little and make a lot. And in either case, what doesn't matter is how the odds work. What you care about is what we call expectancy, and those who trade options understand this. If you have a 90% win rate, but if that one losing rate caused you to lose everything that you gained in the 90% win, then the math is it a positive expectancy or negative? And sometimes you don't know unless you look at the numbers and do the math and figure it out. But I'll give you an example. If you make $10 for every winning trade and you lose 100 on that 10% chance of losing, at the end of the day, that means you win 9 times, $10 each is 90, and that one time you lose 100. So you're negative $10 expectancy. On average, in 10 games, you're going to win 9 times, which is $90, and on the 10th time you lose, and you lose 100, that means you're minus $10. So expectancy is how you measure your overall risk. And this is what you want to look at from a risk-reward ratio. As an option trader, this is what I do. But also as an investor, you should be able to figure this out. Now, why do I bring this up? I'm going to do a really quick spreadsheet. You'll see the average return rate on an S&P 500, depending on which study you read, suggests that you're going to make somewhere between 8 and 10% average return over the last 60 or 70 or 80 years. I think the numbers are like 10.5%, 10.7. But again, people argue over the numbers, so I don't want to argue over the average rate of return. Now, what's incredible is if you're employing a S&P 500 index strategy and you're doing it inside a 401k plan with a match, you can see how that will give you a slight advantage. For instance, if you got a 50% match up to 6%, by you investing 6%, the value is worth about 9% of your salary, because you get this 6% is coming from your salary, and then 3% is coming from your employer matching the funds. And when you look at that, right, in theory, then the money that you're really putting up is this free money will give you a few percentage points above what you're really getting. And over the lifetime, that may mean you're making a 12, a 13, or 14% rate of return using the same strategy of the S&P 500, because a few percentage point difference come from the free money you got from the match. Some people have dollar for matching, so that will skew the percentages higher in your favor. Some people only got a quarter matching, which means will skew a little bit less. Real estate is also very debatable on the percentages. Those who buy it at the bottom, obviously you're going to get a better return. Those who buy with very little cash down, fully leveraged, right? And if the property goes in your direction and you make a lot of money, you obviously make a little bit more. Those who put 20, 30, 40% down may make a little bit less because you're using less leverage. So real estate is also very tricky on measuring average rate of return. I'm not here to argue over which one is better between stocks or real estate. You can make money on both, or you can lose money on both. So that's not what I'm here to argue about. But what I am here to talk about is Bitcoin and things like Ether. Digital currency has been around for about 10 years for Bitcoin. Ether has been around for about 5 years. And so what is the expected average rate of return? Now, based on the data we have, it's very short. Again, Ether is 5 years, Bitcoin is 10. So we don't have enough data to know. But based on what we have, it's easy to assume that you're going to make more than 50% on average of your money back. Now, if this thing's a Ponzi scheme, or if it's garbage or some type of bubble, the asset can be worth zero. Bitcoin can be worth zero. Ether can be worth zero. So your rate of return can be zero, right? You'll lose everything. And so I don't want to ever pretend there's no risk. Now, let's go back to what am I doing? Does that mean you should put $1 and buy a lottery ticket and hope that you make 400 million in the Powerball? And the answer is no. And the reason why is obvious. Because your odds of winning are less than 1%. It's so small, it's 0.00 something, right? 0.0001%. The odds of winning are really low. It's 1 in who knows how many million, 100 million people. And so it's not worth it. How about a game of poker? Do everybody win on a poker table? The answer is no. And it's the same concept. If you play over time, all the money or all the chips will eventually flow to the last 2 or 3 people. And in most tournaments, you know, the break-even point is like the top 30% of finishers will at least break even of their buy-in. And then, but really, think of lottery as you collect a pool of money and then you just move it all to a few hands. So first position will have like 98% of the pot, you know, and then maybe the second position will have something else. So really, all that money is coming from the pool. It's like a lottery, and the chances of winning that first 2 or 3 positions are pretty small. So that's the way you got to understand it, because the chances of breaking even are really small. Now, if you're a skilled player, it may make sense, right? If you have a win rate that's really high, and if you play a long time and you realize, hey, on average, I'm making more money than all the buy-ins combined, right? And you've been doing it for a career. So that makes sense. So why am I saying this? So Bitcoin has this unique feature of, can it outperform the other asset classes? It is my belief at this point, the data has shown that Bitcoin will outperform even the S&P 500 or real estate. And because of that, there's this asymmetrical risk. You can put in $1 to make 10 times your money, 25% your money. A lot of people make 100%, 1,000%, or more. Some people made 1,000,000% return on their money. And because it's high risk, no one is ever going to tell you to put in all your money. And that's really stupid. I know people have done it. No one should ever suggest that to you. But if you're investing, let's say, very small money, less than 1% of your net worth, or 1% of your net worth, most people can afford to lose 1% of the net worth. So if you're worth $1 million, It's right. Some people say, hey, I can afford to lose 1% of $1 million. So they can afford to put a $10,000 bet on a Bitcoin or on whatever coin that you think will pop in the future. And if you did that this year with Solana, a lot of people made 15,000% return in the year 2021 with Solana. But the average coin, I think it's 60% for Bitcoin this year. Ether returned like 130% this year. So there's a lot of other coins where you can make money. And this is where I decided to do something with my personal portfolio. I decided to reduce the amount of money I'm saving in traditional investments, like a 401k plan. And the reason why is what I just explained earlier. I expect my dollar to be worth more, let's say 5 years from now or 10 years from now, in my Bitcoin portfolio over my 401k portfolio, because I believe that the risk versus the reward is much greater in a Bitcoin or Ether or whatever coin I'm picking. On top of that, those who follow the stock market also know that the markets have outperformed the historical average over the last 10 years. And what that normally means is you're going to have some type of reversion back to the mean where the markets will now underperform for the next few years. Whatever, I don't know what that means. It could be 4 years, 5 years, could be underperforming for 2 or 3 years, and then another bull run happens. I don't know, but I don't like the odds of putting a new capital into the S&P 500 at this point. So what I'm doing is I'm reducing it. I'm still investing it through my paycheck, right? If you have a 401k plan, you're still going to invest money there, but I'm reducing future allocation into that asset class, moving it into a different asset class that I believe will outperform over the next 5 years or next decade. And with that being said, I did another video on things that I'm looking at. I do think smart contracts and DeFi and NFTs and play to earn and play to there's a lot of other areas where I think you can make money, but it is high risk. So I am only putting in really small amounts each month. I'm not investing a lot of money. I'm talking about, right, if a typical person is, let's say, saving $500 a month on average, I'm just taking, let's say, $50 or $100 out of that 500. So we're talking about 20% of what you normally invest, and then I'm putting it into a higher asset class. That's all I'm doing. Basically, you're taking a piece of what you normally invest in traditional stuff and moving it to a different asset class. And that's all I'm doing. So what that means is, relatively speaking, even if it's 20 or 25% of my new capital, it is still relatively small from my total portfolio net worth. With the hopes that all you need is 1 or 2 investments to 10x, 25x, or 100x your money, and then the portfolio will become heavier and heavier into this new alternative asset class. Hopefully you understand that. Hey, if you understand it and want to comment below, let me know what you're thinking. What are you doing? Again, there's a lot of people who want to take too much risk. I'm not into taking too much risk. You have to manage it appropriately because things do go to zero. People lose money in almost every investment they do. I know people who blow up their accounts in options trading. If you do stock market, you do penny stocks, and you go all in 1 or 2 stocks that you think will be a sure win, and you lose all your money. That's a dangerous way to live, and you have a lot of stress. I'm trying to invest with no stress. That's why I use low-cost S&P 500 index funds. But even with Bitcoins, you can reduce the way you do it so that even if you lose every penny in Bitcoin, it is still not a lot of stress. It's almost no stress because you're managing your risk appropriately. Okay, with that being said, hopefully you understand that. I'm going to end this video. So let's do this $1 at a time. Let's do this together. As always, have a profitable day. Bye-bye.